listening to Her Profit Era, the podcast for founders who want a business that actually works. A business that's profitable, predictable, and pays them well. I'm Cindy Kumar, a CPA, a fractional CFO from Abbotsford, BC, Canada. I'm the person founders call when they're tired of high revenue months with no money left over. I started this podcast because too many founders were chasing sales while their margins, cash flow, and bank accounts told a completely different story. I believe profit and money in the bank is the standard, not a bonus, and that every founder deserves clarity around their numbers. Each week, you'll get real financial strategy you can actually use and honest conversations with founders and industry experts about what it really takes to build a business that lasts. Today, I want to talk about the importance of the timing of when your bookkeeping is done and the impact it has on tax planning. So I worked with a client who had a July 31st year end. Now, it's important to understand your personal taxes are based on a calendar year end. So from January 1st to December 31st, that is what impacts your personal taxes. So if you are paying yourself salary or dividends, it's based on the calendar year, regardless of what your year end is. Now, I worked with a difficult bookkeeper who only prepared the books on a quarterly basis and refused to get my client's books done until December 31st. So the client thought this had no issue on her tax planning, but it actually did. So here's the breakdown. Again, the client had a July 31st, 2025 year end. So Q1 for her was from August 1st to October 31st. Her bookkeeper did her books a month to 2 months after. So this quarter's QuickBooks was being done between November 30th and December 31st. Now Q2, November 1st to January 31st. Now this is when the December 31st would be done. So it was being done between February 28th to March 31st. Now, the issue with this is that dividends need to be filed by February 28th for the previous calendar year. That gets reported on your personal taxes. So we had the books done until July 31st, and the client had estimated the remaining amount up until December. Well, she underestimated it and ended up withdrawing more than she had told me when we did her estimates. So based on her estimates, she was saving about $1,000 per month. And when we did her personal taxes, she withdrew more, which put her into a higher tax bracket. Plus, she had some employment income. So she ended up owing double the amount that we had estimated. And it's because tax planning only works if there's accurate numbers. So if the bookkeeping had been done on time for Q2 for her, then we would have no problem estimating the correct amount because our books were done on like February 20th. Dividends had to be filed by February 28th. And then since the books were done after our meeting, she ended up withdrawing more than she had told me for dividends. And the reason I'm sharing this is because that the timing of bookkeeping, the timing of when your year end is, it all needs to like flow and make sense. Now, with corporations, like you can choose any month end as your year end date, but you gotta remember that personal taxes are based on a calendar year end. Dividend slips need to be filed by February 28th, so you can report that income on your personal taxes at April 30th. And this is like a reminder that when you do your bookkeeping matters. So if you're using QuickBooks and you have like a year end that's not based on a calendar year end, then I would recommend doing your books on a monthly basis so that there's no issues with like tax planning, estimating your taxes, making sure like everything is done on time. And like timing issue is very big because you could think that your estimated taxes are going to be a certain point. You use like the Well Simple tax calculator, or you work with your accountant and they give you a rough estimate. Well, that number could be completely off, and you could be end up paying like more, which you haven't anticipated for. So it's really important to really prioritize tax planning, really sit down, understand like your corporate year end date, understanding when your corporate taxes have to be filed. So you have to pay them 3 months after year end. You have 6 months to file after year end, but then you also need to factor your personal tax filings as well. So those are based on a calendar year end date. Dividends need to be filed by February 28th. If you have salary, that also needs to be filed by February 28th as well. You want to make sure you're paying like the correct payroll remittances. Another thing is that if you have like other sources of income on your personal taxes, let's say you have like real estate investments, maybe you're withdrawing your RSPs, maybe you're investing in RSPs, you have medical receipts, donations, you have childcare. Like all of these things are going to impact the tax balance that you owe. So even when you do like your tax planning with your accountant, you should be discussing all of these things. Like, do you have an investment property where collecting rental income? What does that kind of look like income wise? If you sold a property, what are the capital gains on that? If you have like some sort of like employment income, or like you had some contract income, like all of that has to get factored into your tax planning. And that's why personal tax planning and corporate tax planning go hand in hand. Because if you want accurate planning and you want to be able to make those tax installments, or maybe you want to save like on a monthly basis for that tax bill for both your corporation and your personal taxes, like you need to know all of these kind of things. And this is why you can't wait until the end of the year to find like your tax sheets, your tax income, all of these kind of things. Like it needs to be done on a monthly basis, and you need to have at least quarterly meetings with your accountant. Those should be non-negotiable. Otherwise, you're going into reactive mode. You're going to end up owing more than what your accountant or what you had estimated. And then guess what ends up happening? You end up putting like a payment plan in place with CRA, you're paying interest, penalties, and then you're just spending the whole year paying off like last year's mistakes rather than being proactive for the next tax season. So, really, the key takeaways are understand your corporate year end date, your payment dates, like put those in your calendar, sit down, write them down, understand the timing. Also put a plan in place with your accountant to do proper planning. If you have like an external bookkeeper, make sure that things line up on their end as well so that they can do your books on time. And if you are doing your books quarterly, like you still need to make sure that December 31st is accurate so your accountant can file like the correct dividends or the correct salary. And all of these things are just really key. And it's like a factor that I help my clients with. So, like for me, it's not just about like filing your corporate tax return, giving you like your tax balance, and that's it. My clients will tell you like we do their corporate filing, we do their planning, we're making sure that their personal taxes are all figured out at the same time we're doing their corporate. I'm helping them with their quarterly tax installments going forward for the following year. I'm telling them if anything changes drastically before the year end is over. We're checking in like 3 months before year end, making sure their installments and everything are up to date so that they're not paying more taxes than they need to, and also that they don't have a surprise tax bill at the end of the year. Like we're planning for it ahead of time, and everything just makes so much more sense and more clear. And this is the importance of the timing of everything. So I highly encourage you get into the habit of prioritizing your tax planning, sitting down with your accountant, doing all of this work, because it's going to go so much further than being reactive every single year with your personal tax filing and your corporate tax filing. Along with like your GST, your payroll remittances, like there should be no surprises there. So that's it for today's episode, and I'll see you next time. If you're a founder who wants real strategy, not noise, and you want someone in your corner helping you build a business that feels aligned, is profitable, and actually supports your life, you can apply for CFO on Call. This is my one-on-one financial partnership for established founders, typically making between $500K to $2 million, who want clarity, who want structure and confidence with their numbers. The link is in the show notes so you can schedule a profit strategy call, or you can DM me CFO on Instagram at itscindykamar, and I'll send over all the details.